Good morning. It's July 15th. Pleased to have Harry Warner with Fahrenheit Advisors, who leads our nonprofit practice, and Tim Call, who's President and Chief Investment Officer of the Capital Management Corporation. Today, we're just going to have a kind of a quick conversation here about some of the challenges in the nonprofit world, both from a strategy and fundraising perspective, as well as from an investment perspective. And just wanted to have Harry introduce himself and what they're doing there at Fahrenheit Advisors.
Yeah, thank you, Brad and Tim. I appreciate you all asking me to be a part of this. Fahrenheit Advisors, it's a multifaceted consulting firm providing search and recruitment and financial strategic planning, as well as fractional employment type. And I've been involved for about a year and a half now, heading up the nonprofit side, working with nonprofits and strategic planning, fundraising, and the other aspects. So very broad range.
Tim, could you give us some background there on Capital Management Corporation?
Capital Management is a registered investment advisory firm. We've been around a little bit more than 50 years, 100% employee owned, and we manage portfolios of stocks and bonds. And with stocks, the emphasis is on long-term growth and recurring cash generation by the companies, which might include recurring cash dividends as well. And so we have different portfolio strategies ranging from growth to growth and income. And we can also customize portfolios and make sure they adhere to different SRI requirements.
Great. Well, let's just jump right into it. Harry, obviously COVID is throwing a curveball to a lot of nonprofits, and they've had to readjust, obviously, in a difficult environment where fundraising, I'm sure, has been challenged. What kind of strategies and pitfalls have you been helping nonprofits avoid?
Well, certainly with the starting with the lockdown in mid-March, it's been a crisis unlike any other. Typically, contributions and philanthropy dries up when faced with a crisis like we have. Contributions, of course, they're a discretionary item, expense, or just a donation in itself. So as people and companies and foundations, they look at keeping their cash and investments whole, or as best as they can. Contributions consequently drop off, of course. So what I've been seeing, all of them, for the most part, are struggling in some form of fashion, which is understandable. They, like businesses, have had to furlough or lay off people. Of course, we are now just seeing in the phase 3 that we are now reopening throughout the Commonwealth. Some of that is being seen in the museums and cultural organizations. Of course, schools, private institutions, colleges, universities. There's still a lot of unknowns coming this fall. And it's going to continue to impact as other revenue streams are not going to be readily available as well. So what I've been doing is working with nonprofits to kind of shore up, if you will, their relationships with donors, and to make sure that they keep those doors open. Not necessarily soliciting for funds right now. I think that we are all just in a kind of a mode of making sure that we're able to survive.
Great. And from an investment perspective, Tim, usually we've always heard, inflation plus 4% for nonprofits to, be able to run their daily budgets and operating budgets. Along those lines, Are you still hearing that? And then what kind of investment mistakes are you seeing them make? As you know, obviously there's been a lack of interest rate environment here, year zero and such. So there's definitely challenges from the investment side. Where are you seeing from your side?
Well, investment plus inflation plus 4% is what the average charity seems to be using now. And there's a lot of pressure to go down to inflation plus 3% because interest rates are so low. So they're just not making much money on their bond portfolio unless they're taking inordinate risk. We still think you can make inflation plus 4% by making sure your stocks are in dividend growth stocks. Basically, you have allocation to equity income where you can get an average dividend yield easily of 3 or 4%. And the mistakes that we see being made are not adhering to your investment guidelines, your previously created investment guidelines. It's normal for in human nature to want to be more aggressive at the tops or want to move money into what's been working the most and to get out at bottoms. So the fear of greed cycle affects most people, even the members of investment committees. So you want to make sure you're staying within those allocation ranges because it'll be tempting to leave and most tempting to leave at market extremes. And that's would be a big mistake. Basically, that would be selling low and buying high. Another mistake we see is putting too much money in illiquid investments. Alternative investments may serve many good purposes, but for a smaller nonprofit or for a nonprofit that needs a great deal of liquidity and cash generation, high allocation to private equity or alternative investments would be a mistake. A lot of institutions right now are asking, what can we sell to generate the cash that we need? We need more cash now than we thought we did. And you can't sell illiquid investments. It's very hard to even get a real-time valuation on those. So if you have most or all of your investments paying you cash in the first place, so have your stocks paying you dividends and the bonds paying you interest, you already have some cash cushion. You don't have to go into much of your principal. But when you do have to go into your principal, following those asset allocation guidelines will make it so you're selling high and buying low versus the normal human inclination to do the opposite. So those are the biggest mistakes with not adhering to asset allocation guidelines and putting too much in illiquid investments.
Great. And on that front there, Harry, with potentially nonprofits having to scale back and look at more of an inflation plus 3 environment, what impacts are you seeing towards organizations being able to fulfill their mission and serve constituencies and such?
Well, of course, that's those nonprofits that have the luxury of having an endowment or a foundation. They're kind of far and few between, of course. So that just kind of adds fuel to the fire of reducing revenue, of course. I always come back to needing a strategic plan for particularly right now for organizations. They need to know where they are right now at point A and where they want to be point B. And given the circumstances that we're in right now with reduced philanthropy, reduced returns on investments, liquid investments kind of thing, and even program revenue, whether it's going to be regardless of what it might be, and even government support too. I think that nonprofit organizations have to look at where they are in a worst case scenario and try to, through a strategic planning, very systematic, look at where they can be in 2 or 3 years kind of thing. And part of that is looking at their donor base and prospects. There's a donor cycle. if you will. And to, again, it all comes down to relationships and cultivating and stewarding those relationships with current donors. But organizations have to look at the cycle of identifying folks, those who are prospects and even current donors of capability, researching, cultivating, that's the big C kind of thing. And then it comes down to solicitation. And we're not necessarily in a solicitation mode, like I said right now, but just because donors aren't necessarily in a giving environment, but maintaining those relationships, then you can solicit, and then it's a matter of stewarding after that.
Great, great. You know, flipping back to you, Tim, you know, it's a common point of debate is active versus passive management, and whether it makes sense sometimes for the active management for a nonprofit. You know, I hear quite a bit of, you know, why don't we just buy the market S&P 500 index? What kind of thoughts could you provide for everyone here on that?
Well, just like there's a donor cycle, there's lots of cycles in the investment markets, and active managers, on average, have a cycle in which they do very well, and then when they're out of cycle, it's the indexes that are outperforming. So it goes back and forth over multiple year cycles, and we've been in an extended cycle of the index funds doing well, and when that happens, near the end of that cycle, there tends to be over concentration within the index funds. And we have that today. We have the two largest stocks within the S&P 500, so an index of 500 large cap stocks. So the two largest represent 12% of that index. The smallest 250 large cap stocks represent less than 11% of that index. So that index is very top heavy. And when you look at the top 5 holdings, normal humans would define them all as technology stocks. Same with when you look at the overall S&P 500 and the weightings, over a third of the weightings are in what most of us would refer to as technology stocks. And that's not diversification, especially after a long run with the NASDAQ hitting new highs today during a pandemic. Some of these technology stocks are overvalued. And so you have an over-concentration of overvalued stocks, and that tends to be the case after a long run of index funds. So it's a great time to make sure you have active management as part of the overall picture. And the active management can help with broadening the diversification. So having more value, income, or small and mid-cap stocks in the mix, and making sure you're meeting the goals and objectives of the organization. So it's not just risk management, but it's also income generation and customization that can occur within the portfolio. So there are lots of goals going on, and the indexes can't meet all those goals. Plus, right now, we find the indexes to be rather high risk due to the excessive concentration of technology and mega cap stocks.
That's terrific. I really appreciate both your time, Harry and Tim, and we look forward to hearing doing future interviews as well, as hopefully things turn up on the rise here going forward.
Agreed. Yeah. Thank you, Brad.
Thank you, Brad.
Thank you, Tim.
Thank you, Harry.